Hi, I'm here to talk about angel investing and why India today, incidentally, is the fastest growing startup ecosystem in the world. It is growing at doubling its rate and trebling its entrepreneurs. And all you entrepreneurs out there are actually the ones making it happen. You're not only taking India to the next level, but you're also what I would call the job creators for this country. Now, as you build your companies, how do you fund them? The very early stage funding, which is about 2 to 3 crores, is extremely difficult to raise and extremely difficult to get. Banks honestly don't invest or do not lend because there's really no collateral. The very fact that you're a startup tells you that there's no history, there's nothing to collateralize. It is here where angels come in. It is here where angel investors come in. And this concept is not new in the world. In fact, there's a very interesting story that Shakespeare, when he was producing his plays, he was hard of money. And it is the ladies of leisure which came in and funded his plays. Today, that concept has really gone to a different level. Angel investors are people who built companies successfully, taken them from garage to IPOs, people who've really built large businesses, understand what it is to build businesses, and have created wealth. They are now investing in you, young entrepreneurs who are starting out with very innovative propositions. So, angel investing is that class of money which brings in not only the check, not only the remittance, as today's digital world tells us, but also a lot of hand holding, guidance, opening up global networks. So, that's what we'll try and focus on today. And just to introduce myself, my name is Padmaja Ruparel. I'm co-founder of Indian Angel Network, perhaps the world's largest angel investing group. We have almost 500 investors. And we're now creating the single largest horizontal platform for seed and early stage investing. About 15 years ago, we brought in the concept of angel investing, and today it's great to see angel investors grow by numbers dramatically in this country. So, guys, honestly, build a good company, there is money out there. So, the question that comes to mind is how are you going to raise that money? There's money out there and you need the money. What do these investors want? What do they look for? So, let me focus a little bit on that because that is very important. These investors, just to give you a little background, is invest in the shares of your company, which is called equity. So when they invest at a certain price, let's for this discussion take it that they are investing at a rupees 100 per share, which is the price that they would pay. They are really looking to increase the price of the share or the value of the shares 10, 20, 30 times, right? So the 100 rupees share, they would like it to become 1,000 or even 10,000 rupees and then sell at some point. So they get their returns when they sell their shares. And if they sell at 10,000, then they're really making 9,900 rupees on the shares. That is how angel investors, in fact, even VCs, operate. These investors really don't want you to give them a dividend and surely not an interest. So, what happens is all the money as you grow the company goes into building the company. Now, if they want to invest in the shares of the company, they are looking for companies or young entrepreneurs who are able to grow large companies rapidly, which means there needs to be a proposition or a product which is catering to a need in the market. It needs to have a customer which is either feeling a pain point or is enabling him or her to do something better. So let me again give you a little bit of an example. If you look at the BPO industry, what did it do? It allowed customers to do things differently. They said that we will go They told their customers, we will pull out all the things that you are not core to your business, and we will deliver that to you while you focus on the core business and deliver to your clients in turn. And that became the genesis of today, what is a globally acclaimed BPO industry. If you look at things which are to do different, right? So many of us who are in a different generation will remember the landline phone. We could call, but we had to stand in one place because it was wired, and the only thing we could do was talk. Today, it has changed completely. All of us have mobiles. What are we doing? We are speaking on the phone, but we are doing so much more with the phone, including this Facebook interaction. So you are doing things very different. It has changed customer behavior. So that is very, very important when you build an innovative company, to think, what can you do better for your customer? Because if you don't do that, honestly, the customer will not buy your product. Second is, it needs to cater to a very large market. Because if it doesn't, again, the share price doesn't go. Keep an eye on that. It's important. So let me again illustrate, because I think honestly, illustrations will give you a much better idea of what I'm saying. It needs to be a large and a growing market. So many of us go and buy ready-made shirts. It's a need. It's not a nice to have. You need to have a shirt. You need a shirt or a dress which you can wear every day. So irrespective, you're going to continuously buy that as long as you need and as long as you're around. And then you have boutiques, which will have clothes which are very fancy but at a very, very different price point. Now, those are not really need to have. They are what I called nice to have. And that's not going to have a large market, because there's going to be a very small segment of the customer who will buy that, and he or she is not going to buy it regularly. So then these companies, these investors look for companies which are catering to a large growing market with a need to have proposition where the customer is almost compelled to buy these products. So that's the second point. And these are two very, very important points as you build your companies, because angel investors and look for companies like these. The third piece, which I think is not very emphasized usually, but I must bring it in here, is they look for competition. In your space, to your product, what is competing? I get about 10 to 12,000 business plans per year. Honestly, there are many entrepreneurs who come and say, there is no other product like mine. There is no other comparator like mine. What I want to tell all you entrepreneurs, it is not a comparison between product to product. It's a comparison of solution to solution, right? So your product could be very well differentiated. I don't doubt that. But the customer is not comparing products. The customer is looking for a solution to his problem, which could be assuaged by any product, right? So think of it in a different way. There's a thirsty man. He needs water. But if there isn't water, he'll do with any soft drink. At that point of time, the thirsty man is really your customer. And the solution he is requiring is not a glass of water, is to quench his thirst. And that is something so fundamental that I think we do need to keep that in mind. And investors will ask you this question, and they look for such solutions to again alleviate the pain of the customer. So keep your customer centricity paramount. It cannot be diluted at any point of time. The next piece to me is very important, which investors look for, and I must confess, we look for it as well, is that how are you going to deliver? So you have a product, you've identified your customer, You've probably even figured out who your competition is. But how are you going to access that customer? And that, in the parlance of investment world, is called GTM, or go to market. How are you going to go and access those customers? How are you going to figure out where your market is? How big is that market? Who is important in that market? And which is your accessible, or TAM? TAM is target addressable market, which means what are you targeting, and out of that target market, what is the addressable market? That gives you the size of the market, and investors will invariably look out for this, because remember, they're looking for a large market proposition, and TAM becomes extremely important. You figured out your TAM, you figured out how you're going to go and access that TAM, but how are you going to convert that market into customers, which is called your sales strategy or customer acquisition strategy. So, who in the organization are you going to sell? Who is going to write the check, or who is going to make the decision? Let me again explain this, because it's very, very important. Let's assume you have a software product which you're trying to sell to some corporate or a company, and it's in the space of HR. Many of us actually think it's the CEO who's deciding. No, it isn't. It may be the HR guy, head, or it may be the IT head, and we need to figure that out. Again, remember one of the things I said earlier, who is feeling the pain point? Is it the HR guy who's looking for data, who's looking for a track on his employees, or is it the IT guy who's looking for security, who's looking for privacy? So your product needs to be well thought through and understood to say, am I providing a solution to the IT problem, or am I providing a solution for the HR problem? And therefore, depending on what your problem is, what your product is, let's assume it's catering to the HR issues, your decision making person is the HR head. So you need to sell to the HR person. If he is on board and he says, hey, this is a product that solves my problem, this is a product that will cater to what I'm looking for, you're on. After that, believe me, he will go and sell to his CEO, and he will go and sell on your behalf also to the finance head to get the budgets. So please understand, it is not selling to a company, it is not selling to a CEO. You need to identify who is your customer, who's feeling the pain point, and who is the decision maker. This, to many entrepreneurs have come back to me and said, oh, I did connect with the chairman, I did connect with the CEO, but my conversation didn't go forward. It will never go forward, because the CEO doesn't feel the pain. He's only demanding of his HR head that I want this information. It is the HR head who's feeling the pain. So please identify who exactly is your customer. If you are selling a toy, who is your customer? It is not the parents, it is the child. It is the child who demands that toy. You need to cater and focus on the child, right? So identifying customers and getting them converted as customers is extremely important, which is what I would call the customer acquisition strategy. Now you have a customer who's sold. He's also given you a purchase order, or he's also given you a go ahead to buy it, to deliver. What's the next piece? Is your pricing strategy. He's saying, listen, I like your product, but I need to understand what's the price. And here are 3 different solutions that I have. Is pricing important? And pricing strategy is never driven only by lowest price. This is also very, very important. Please understand, you cannot continue to sell, and you cannot be a sustainable company if you're going to be selling at low prices, giving you very low gross margins. Margins are very important to keep in mind. another point which investors will look out for. Because even for a customer, if you're going to sell at a very low price, he will figure out that you're not going to sustain on the margins for a longer time. And if it's not a long time solution, if it's not a long term solution, honestly, he'll say, I'd rather pay higher and go with someone else who's going to provide an ongoing solution. So, pricing strategy is a huge discussion point, and I think for all you entrepreneurs out there, bring this on your table and brainstorm it with people from the industry, people from who are your mentors and your co-founders, etc. Great, you have all of this sorted out. Now, how do I get the revenues? Revenues don't come on the basis of purchase order. They come when you deliver a product. Only and only when you deliver the product to the customer, he's used it and he's satisfied, will he pay. It is only on delivery that it becomes payable. Only then can you start thinking of money flowing into your bank account. So delivery means a huge, huge issue which needs to be solved. It's not easy, let me tell you, especially for young startups like you. If you have a very tangible product which is not, like, I'm just taking an example to illustrate what I'm saying. So let's say you have a manufactured product, right? You need to figure out what is the BOM. What is BOM? Bill of materials. How do you do that? You need to figure out your cost of components and raw materials. You need to figure out your supply chain, which means your vendors which will be providing you the different components and raw materials, right? Which goes into the BOM. You need to figure out where is that going to be assembled or manufactured. As a young startup, we are all aware and quite accept the fact that you will not have your own factory. You will outsource or you will contract it out to people who will manufacture it for you. And you may have pieces manufactured and assemble it in your factory or in your shed. We understand that. So how are you going to identify those contractors? How are you going to bring all that together? If there is an IP in the product, how are you going to secure your IP? These are all questions that will come up. And these are all good questions for you to answer as well, because ultimately it's your company. Once you have the product, you have to figure out how are you going to deliver it, which means what packaging, what is the logistics provider, how much time does it take, what if it is damaged, is there an annual maintenance contract, is there an installation element required? All of these things constitute what I call the delivery piece of the business. And this is absolutely critical because you've put in so much effort in building a product, in identifying the market, in understanding how you can be differentiated, in getting the customer on board, bringing the purchase order together. And if you don't deliver, all of that effort is diluted. So getting the delivery piece is extremely important. Great, you've now got that as well. Now you need to figure out that how is he going to pay? Have many of you must have heard, collections is a big pain point. So you've delivered and your customer has told you that you're going to get money in 30 days credit, which means after you've delivered, he's going to pay you in 30 days. It's hard. I completely empathize with all you startups out there. You don't have money, you have cash issues, you don't have working capital, and 30 days credit is very difficult. So you need to chase the customer from day one. I would go forward and actually suggest that in your businesses, if you are able to take some sort of an advance from the customer, do not hesitate to do that. It has got two advantages. It gives you a more connected and a more engaged customer. If he's paid you a little bit, he's going to try and make sure you deliver, and he will be very helpful because he's got a stake now. Second, it assuages a bit of your working capital requirements. So please try and take an advance. Please chase your customers for collections. It is something which is due to you, and there is absolutely no reason why you should not. And it's imperative that for you to understand that many businesses have faltered just because collections have not been made on time, or in many cases have lost money. And this, again, from your perspective, it's your company. You need the money more than anything else. And believe me, the best way to build a company, the best funding that a company can have is revenues. If you can that's the best way of funding a company. Angel investors, yes, they will ask for this because this is important for the company to stay afloat, for the company to bring in monies, to the company to grow. They will ask for this. But even beyond the investors, for your sake, for your companies to succeed, it's important. The next piece is really what I would call the team. For me, individually, as an angel investor in many, many companies, I think almost 60 to 70% of points that I give for any startup is the team. I look for teams, and many investors look for teams which are really know the domain, they understand what's to be done, how are their product going to be built, who is their customer, and how are they going to sell. The team is absolutely imperative. And let me give you the logic as well, why this is important. When you as a startup come, you really have nothing on the table. At best, you will have an MVP, which is a market viable product. You may have 1 or 2 customers at best, right? The rest is really a PowerPoint and an Excel sheet. The biggest asset and the biggest bet that investors take is on you, entrepreneurs. It is you who can make it happen, and it is you who can break it. So investors spend enormous amount of time talking and understanding you as an entrepreneur. Can you make it happen? Is this something you really want to do? Are you going to make this business irrespective of whether I invest or not? These are the kind of thoughts that go. Are you capital efficient? I'll give you many, many stories on this. I mean, this is so key. I cannot emphasize this more. It is this team which is critical. They don't need to have the 2 founders or the 3 co-founders. They don't really need to have everything that a company needs, but they need to have the key elements that the company needs, which is they must understand the domain, they must have an understanding of the technology or how they're going to deliver the solution, and they must have an understanding of the customer. And most important, come what may, they need to be leaders, because it is they who will build the team and they who will be the leaders of that team. They who will be CEOs or CXOs of that team. And founders are so critical because it is because of them that the team will come in. Others will join in. You really have nothing when you have a startup. It is your passion, your commitment, and your ability and understanding of that space that will make others join you. You cannot pay market salaries, but it is you as a leader who can convert the best talent to come and join you. And therefore, team is imperative. I repeat myself because this is so critical. And for founders to understand that they are salesmen 24 hours, 7 days a week, 365 days, and they are selling to everybody. They are selling to their customers because they're selling their product. They are selling to their team because they're telling them, listen, one day I'm going to be $1 billion company, come and join me. You're selling to the team. You're selling to your vendors to say, listen, I'm going to build a big company and then I'm going to give you lots of orders. But for now, give me this in lower prices and I'm going to pay you in 45 or 60 days instead of 30 days. You're selling. You're even selling, believe me, to your co-founder because he or she may be stressed and you're the one who's saying, tomorrow is another day, let's get up and get going. You're selling. And you're also selling to your spouse and your children to say, hey, go for the movie, I'll just swing by the office and come. I just need to go. So you're selling. So a founder is selling all the time. The TRP ratings of the founders have to be at its highest. And that to me is the high and the low of being an entrepreneur. You are on a high all the time and it's difficult. I completely empathize with all you entrepreneurs out there. It's not an easy path. You are walking a lonely path. But believe me, it is this team which can make it happen. And the only way they can make it happen, and I'm going to borrow a little bit from Vidya Balan to say the only thing is execution, execution, execution. You have to keep building, keep selling, keep delivering, and collecting. Every day, small pieces, small steps ahead makes for a big company. Believe me, it works. It's worked for decades, it works for centuries, and it will continue to work. So, all you guys out there, the success of your company lies in your hands. You can make it happen. Many entrepreneurs come to me and ask me, how important are financials? Let me give you a little bit of a view there. When we look at the Excel sheet, we focus not on the right-hand side columns. We really focus on the first left-hand side column. This column gives us an idea as to what has the entrepreneur thought through all the different revenue lines that his product can sell. And more importantly, how deep and how detailed is his thinking on the different cost lines. This is very, very important because we understand as early stage angel investors, they completely understand that this is an Excel sheet and data can change, right? One data point changes, the whole Excel sheet changes. But it is the depth and detailed thinking on the left side which becomes imperative. And that is what investors look for. Last point before I stop is what do investors look for when they invest? They look for equity. The question therefore arises, how much equity? What percentage of my company should I dilute? And the investor's thinking, what percentage should I take? It's two sides of the same coin. This is your company. You need to understand how you value the company. And the way you do it is through various mechanisms. But I would strongly suggest all entrepreneurs to please interact with your mentors, network with other entrepreneurs in your space, talk to a lot of investors and understand how they value. While you think you're a billion-dollar company, the reality is the beauty lies in the eyes of the beholder. The investor or an employee may not think that. So a reality factor is very, very important. And that is where we converge onto a number for valuation. I would just want to also add here that angel investors, high quality angel investors, who really put in money, put in time to mentor, try and spend a lot of their networks, leverage their networks to help companies, is what you're looking for. Just writing a check or just getting a check writer is really not enough because you're standing on your own. You need to get into a much larger ecosystem to grow your company. And therefore, look for angel investors who bring value beyond the check. And these investors who understand angel investing, who understand what they're getting into and how they can help build companies, will never ever take a majority stake in your company. Please read my lips. High quality angel investors will never take a majority stake in your company. It will always be a minority or a significant minority at best. And that's a big test for you to understand who you're getting along. When you bring in investors, and when investors invest in companies at this stage or entrepreneurs, the most important factor is how do you interact between the two of you? The chemistry between the entrepreneur and the investor is imperative because it is that chemistry which will actually boil into making or breaking a company. A little valuation above or lower is minuscule points, which will absolutely be insignificant as you grow the company. And therefore, it's important to spend time with your investors and for investors to spend time with entrepreneurs to understand each other. You understand what do they bring on the table, and the investor understands what are the gaps in your team for them to be able to help. And when you see this complementary value addition is what will make it happen. That is the magic. And that is what is one of the big seeds of success. Finally, I would say that think of increasing the size of the pie instead of slice of the pie. To explain this, if your company is worth $100,000 and you have 90% of it, yes, you have 90,000. But if your company is worth 500 million and you have 70% of the company, which is lower than the first instance, then you have 350 million, which, by the way, is almost 4 times what you would have had in 100 earlier. So look at increasing the size of the pie, not the slice of the pie. Bring in team members, share, bring in ESOP, employee share option schemes, share the ownership of the company. They will be much more engaged. They will deliver much more because there is something called ownership. So investors, employees, mentors, create an ecosystem which is working with you instead of you pulling the whole organization. You will achieve much more together than you achieving it alone. I will stop here, and I believe there are some questions which I will take. Hi, so I've got some questions and I'm going to try and respond to them. Some of the points I would have made earlier, but nevertheless. One of the questions is, at what stage should we look for angel funding? Are there any prerequisites? And should the business have received some level of revenue before approaching an angel funder? And what to keep in mind while conducting a business valuation before pitching to an angel investor? Okay, so I think this is a very good question because it's almost packaged my entire talk. So whoever sent it, congratulations of thinking so deep. I think angel funding is required when you are, let me step back and explain this. Equity funding is one of the most expensive ways of raising money for your company. Okay, so to step back, the best way to fund your company is through revenues. Build your business as far as you can with customer revenues. Second, and the most difficult way of getting money, and that's the only reason why it's second in my pecking order, is grants. If you can raise grants, please go for it. There is nothing like free money to build your business. And please, घर आई हुई लक्ष्मी को कभी मना मत करना इस तरह से. Number 3 is debt. If you are able to raise debt, it is cheaper than equity. Why? Because the amount of return that you have to give to your debt investor will be capped at 10, 12, 14%, which is predefined. The problem with debt money for startups is it looks at 2 things. Number one, it needs collaterals, right? Women do get away with some debt schemes which are non-collateral based, which the government has instituted, but largely debt money needs a collateral, and that's hard to get for a company at a startup stage. And second, which very few people realize, is debt providers look at the history of the company. They look at 3 years balance sheets, 3 years P&L, what's your cash flow, can you pay back the debt? That's what they're looking for, right? And that's difficult for a startup because typically they may not even be 3 years old, right? And they may not have the cash flows to pay. So they cannot demonstrate an ability to pay the debt back. So that's debt. And therefore, you need equity money or angel investment money, which is not coming free, my friends, but it is not looking for collateral. You are giving equity, you're giving shares of your company to the investors. He or she, as an investor, is going to ride the same risk that you are walking through as you build the company, and therefore they take a lot of judgment calls on you and how you will build the company. And the most important is they are looking at the future of the company. They are looking at projections, how you will achieve that, how well have you thought through that. So they are looking at the projections of the company. So you raise angel money when you have sort of sorted out that the other sources of money are not available, number one. Number two is you raise angel money, which is approximately an average of 2-3 crores. Why? Angels are individuals. They are investing their post-tax paid private money. Okay? So they are writing checks from their personal checkbooks. And therefore, individuals will typically not write more than 3-5 crores. So when you're looking for about 2-3-5 crores is when you go to angels. Okay? And be prepared. A group of individuals may come together to put in that money. So your total amount you'll get is 3 or 5 crores, whatever you need. But individually, they would have put in smaller amounts. And why do they do that? Because in the angel investors portfolio, they have invested in different classes, right? So the investor or the individual has invested in, let's say, real estate, they've invested in mutual funds, they may have invested in publicly listed companies, public shares, and now they are investing in startups, which is unlisted shares. And do remember, angel investing for an investor is the highest risk asset class. So the reason they sort of invest together is to reduce their risk, but give the company the money it needs. So you approach an angel investor when you need this kind of 2-3-4 crores. Yes, when you approach an investor, you must have at least a market viable product. It can be pre-revenue, but you must have a product and some sort of a market validation. It could be a pilot, it could be one product sold to one customer, but there needs to be evidence that there is a product which somebody is buying and there is a customer who feels there is a pain point and is willing to pay money for it. That is the minimum that it needs. Second, please recollect my earlier talk. The product has to be catering to a large market. It cannot be in a boutique, small sized market, because that is not what this class of investors are looking for. Should the business have received some level of revenue? Well, it's not imperative, but if you have received some level of revenue, it builds higher confidence in the company with the investors, and it may make your conversation easier. It also you will be able to share a lot of the experiences that you've had, the challenges you've had to be able to sell to customers and build that revenue. And that's very, very valuable. So it is a good idea. We've had a company which came to us when it was a revenue of about a crore and a half. We did give a term sheet. Okay, a term sheet is basically where the investment terms are put together. Broad investment terms are shared over a two, three, 4 pages, and that is agreed between the investor and the company. And then once that is agreed, we then do a shareholders agreement and diligence, and then that is converted into an agreement. So the term sheet, which is the first agreement on investment terms, which usually has investment amount, valuation, all of those things. After it was agreed, the entrepreneur actually walked up to me and said, "Ma'am, I would like, with all respect to your term sheet, I would like to try and build this company on my own money." And we tore up the term sheet, because I think that's the huge respect that I think investors like us we have for entrepreneurs. If they can build it on their own revenues, nothing like it, and we encourage that. Guess what? 2 years later, that same entrepreneur came back to us. He raised 10 crores at 100 crore valuation, and we recently have Tiger Global investing in that company. This company, by the way, is Wow Momos. So it's imperative to understand why you need the money, and you've sort of sorted out all other ways of raising money, because this is expensive money, and I would like to make that sure that you understand that. When you conduct a business valuation before pitching to an angel investor, guys, I would only suggest build the business. Create first, focus on building an excellent pitch and convince the investor. It's much more difficult to convince an investor and get him engaged rather than talk about valuation in the first place. Once you've got that chemistry going, again, remember what I told you about chemistry? Once you have the chemistry going, believe me, valuation discussion is a cakewalk. Okay? Good, high quality investors are not going to scrimp and scrounge for a percentage point or two here or there. They will want to invest in you because they believe that you can build something, and will be okay to take a slightly lower stake. In fact, I say this very, very often to a lot of entrepreneurs. Please focus on building the business. Do not focus on raising money first. If you build a business, you get it going, you execute, you create revenues, you have customer engagement, and you know where you're going with a team which is following you. You know what? You will not be chasing investors. Investors will be chasing you, and that's the best place to be in. So keep that in mind, because these are things that make or break valuations, and more importantly, make or break companies. Here's another question that came to me. Are there any restrictions on conditions on how angel funds have to be used? Okay, this is a wide question. Remember, angel investors are individual investors, right? So they are investing small amounts of money, which is 3-4 crores. So typically, angel money is not used for any kind of capital expenditure. When you look at real estate, when you look at factory buildings, when you look at large capital equipment, that is not what angel investment is used for, right? So angel investments are used for building teams, creating market access, to some extent brand building, products which can be created quickly. So angel money helps young startups get going nimbly and agilely. So never will you see an angel money being used to buy land, or for real estate ventures, or for large manufacturing, high capex kind of companies. Having said that, I must point this out. There is a perception that angel investors only invest in technology companies. The fact is, Yes, they did start investing in software and technology companies because these companies required a much lower amount of capex. I mean, what capex does a technology company need? It's basically a laptop and a printer or a Wi Fi at best, right? So, yes, they did start investing. But the world has changed over the last few years in India. Angel investors are investing in manufacturing companies. I'll give you one example. We've invested in a company which is a manufactured device which retrofits on gensets to reduce pollution and emission by almost 90%. I did not think that this company would have raised angel money 4 years, uh, uh, 4 years ago, but it has, and it was hugely well received. So, manufacturing is opening up, agriculture is opening up, drones are opening up, uh, a whole lot of these offline plays are opening up. So, for all you entrepreneurs out there who are not necessarily primarily technology companies, please keep heart and keep going. There is angels who are investing in that. So, don't lose heart. It's opening up. Um, do angel funders also look to invest in NGOs and social enterprises? If yes, how do those organizations find relevant angel investors? Okay, so let me go back to the basics. Angel investors invest in the share capital of the company. They buy shares in your company. And what they look for, going back to basics, is to buy the share at an X price and be able to sell it at a 10x or 20x of that price, right? So, if they put money in a not for profit or a non government organization, shareholders are not able to take any economic or financial benefit. That is how that structure is. So, they will not invest or not put money in any not for profit organization as an equity shareholder of the company. If they do put, it's more like a donation, which is a subject we're not talking about right now. So, NGOs as a structure, not for profit as a structure, Section 25 of the Indian Companies Act, what all of these fall under the same bucket of not for profit, and investors. Investors means people put in money and they want returns, will not put in money in these companies. Okay. Social enterprises, absolutely. If they are structured as for profit, catering to a large market, there is a need and there is what I would call a kick ass entrepreneur team, they will invest. We have invested in a number of such companies because these cater to a very large growing need in this country. So, absolutely, social private enterprises or social profitable enterprises, absolutely no issues. And how do you access such angel investors? Honestly, there are angel groups around the country. Please go on to Google, Facebook, they're all over the place. Please access them and feel free to write into them. Angels are not just focused on social or not just focused on non social enterprises. Remember, they need to risk mitigate the investments, so they will invest across sectors, across social and otherwise enterprises. So that was the last question, and I'd like to stop here. I hope you enjoyed the session. And all I can say, all you entrepreneurs, go out there. India is the best place to build your ventures. Make it happen, and Jai Hind.